My name is Mark Boud. I am the Senior Vice President and Chief Economist of Metrostudy. I'm here to share with you the most recent findings of the national edition of the Residential Economic Report. At the heart of this report are modeled forecasts associated with the supply and demand of housing, as well as housing over and under valuation patterns. The new home market will be increasingly influenced by new technology. New technology allows new homes to more effectively compete with existing homes in terms of services, design, and automation. Off-site construction will become increasingly common as time goes on. New home designs will increasingly accommodate solar, home batteries, electric vehicles, and new technologies. Automobile automation has potential to impact the design, density, and location of new homes and master plans. Job growth is slowing, but it remains at a healthy pace. During the past 12 months, almost 2.2 million jobs were created, generating far more demand for housing than is accommodated by current supply levels. Unemployment continues downward at a current level of 4.1%. New home construction starts are far lower than in the previous cycle. Our current forecast for new housing starts during year 2018 is 1.256 million home starts. That is a level that is only slightly higher than what was experienced in 1992 and is far lower than what was experienced during most years of the past residential cycle. This particular slide shows vacant developed lot inventory relative to annual housing starts. As shown, vacant developed lot inventory continues a downward trend, while annual starts are slowly trending upward. Overall trends suggest that housing supply will continue to be restricted over time. Housing inventory and annual closings by price suggest that prices below $400,000 are experiencing very tight inventory levels, while inventory above $500,000 seems to be increasing. One of the ramifications of tight housing supply is a boost in the residential remodeling index. The index surpassed the high watermark set in 2007 back in 2015 and continues upward at a steep level. During the next 24 months, overall remodeling activity will continue at high levels. A heat map associated with remodeling activity shows activity especially high in those markets which tend to be most expensive. Florida, a more affordable market, will likely experience increased activity due to storm recovery. As inflation rises, we're likely to experience an increase in overall mortgage rates. Overall fixed rates have increased during the past 6 months, and gradual increases are likely to continue for the next 3 years. Consumer confidence levels are reaching new highs in this particular cycle, exceeding levels reached in the past cycle. All of this information is compiled into a model which measures overall supply and demand patterns and over and under valuation patterns. National housing demand and supply patterns are shown on this particular chart. The green curve reflects overall demand levels from 1990 going forward through our 5-year forecast. The blue curve reflects overall housing supply levels for the same period. As reflected by the demand curve, demand can go negative during recessionary periods. In the early 1990s, the loss of manufacturing, aerospace, and military contracts led to a contraction of overall housing demand. During the early 2000s, the dot-com bust resulted in a downward trend in overall housing demand. Most recently, it was the housing meltdown felt between years 2007 through 2012. The next downturn is forecast to begin during years 2021 and beyond, and it will likely have something to do with national debt and inflation. The difference between housing supply and demand curves allows us to measure the actual level of overbuilding or underbuilding through time. During the most recent year, pent-up demand is likely to reach 2.5 million homes nationwide and will continue to increase during the next 24 months. Thereafter, a downward trend toward equilibrium is likely to occur. Overall debt levels on a national basis may contribute to the next recession. National debt contributes to reduced economic growth, higher interest rates, a weaker dollar, higher taxes, and a higher risk of financial collapse. During the past 2 administrations, overall debt levels increased significantly due to the ramifications associated with 9/11 and the housing meltdown. National debt is currently measured at over $21 trillion. This is 106% of national GDP, which is over 100% for the first time in history. This particular chart represents housing valuation patterns throughout the United States. The blue curve represents median price of housing from 1990 going forward through our 5-year forecast. The green curve reflects income-supported pricing patterns going forward through the forecast, representing where we think actual price support is. The difference between the two curves allow us to measure the actual levels of overvaluation and undervaluation from 1990 going forward through the 5-year forecast. As shown for year 2018, we are forecasting overvaluation to increase over time before it begins to recede after year 2021 due to reactions to the recession. This table numerically shows the levels of overbuilding and underbuilding, as well as overvaluation and undervaluation from 1990 going through the 5-year forecast. As shown for year 2018, market conditions will remain strong, while buying and selling opportunities for land remain stable. During years 2019 and 2020, market conditions will remain stable, but land purchase and sell opportunities will weaken. Key takeaways for year 2018 and beyond. Tax reform hurts, especially in the high-priced markets of California and New York. The national housing market will continue to be significantly undersupplied for the next few years. The national housing market is heading toward overvaluation, but housing values are nowhere near as overvalued as they were in years 2005 and 2006. The surge in remodeling and renovation will continue. Rising mortgage rates are just beginning, and inflationary pressures are slowly building. National debt may be a trigger for the next recession. Rising rates may contribute to severe overvaluation in many markets, despite only modest price appreciation during the next few years. And finally, we feel we're in the top of the 7th inning in a challenging and rewarding housing market in an environment of undersupply and increasing costs. The Residential Economic Report presents these model forecasts for every metropolitan area throughout the nation. For more information, visit metrostudy.com.